The reality is that many businesses, when you start, what really becomes successful at the end of the day is usually very different from what you started with. And you can ask everybody who has built businesses. The MVP is not supposed to be the worst version of your product. It is the most honest version of your product. What does success look like? You need to be able to say clearly before you start it, because if you do not, everything you do will look like success to you, because it becomes the tail wagging the dog. The MVP is a learning loop. Whatever you learn, you double down on it if it's successful. If it's not successful, you pivot, you change, you reimagine your assumptions, and then you do it again, and then you put it in front of customers again. The worst possible outcome of an MVP is launching it and then not paying attention to the customers that are actually using it and what they do with it. So you do not need to build everything to start. You need to build one thing that proves everything else is worth building. You would all know one entrepreneur or the other who started a business or started a product, and they designed what they believe was the full version of the product they're trying to build, the fully featured products that they're trying to build. They spent 18 months building, and at the end of the day, they launch. But when they launch, the market is very indifferent. In fact, the market is hostile. The market does not respond. There's no purchase. People ignore the product completely. 18 months gone. I'm sure that if I ask every one of us, we will know one person or the other who has been in that situation before. In contrast to that, there's another person with the same idea in the same market, spends basically 6 weeks putting together the smallest version of what they believe can work for that particular problem or challenge they're trying to solve. They show it to a few customers, 1 to 10, 20 customers. They get feedback, they iterate, and they fix those things. And then they show more customers, they gain traction, and then they build the full version. The difference between these two entrepreneurs is really in terms of their willingness to be imperfect in public before they are perfect in private. Hello everyone, my name is Deji, and welcome to another episode in this series we've been doing on building and scaling businesses. This is episode 7 in that series, and we are continuing from the last episode where we talked about validating your idea. And today I'm going to be talking about what comes next after you've validated an idea, and that is you've checked and you know now that the problem is real. What is that smallest, smartest version of the solution that you can build? Many of us might know that term as what we call the minimum viable product, the MVP. And it is one that is actually very misunderstood. And I'll create some clarity around the concept of an MVP. First of all, let's start with what the name is, the MVP, and what it is not. When most people hear the word minimum viable product, what they think of is a cheap product, an incomplete product, a product that does not serve the customers or clients that you're working with very well. Something that is half built, is just a prototype with duct tape that is patched all over it. It can be that. And I think I gave an example in one of the videos I've done earlier about one of my colleagues from business school who has built a very thriving vending machine business. And when they started, I followed very closely what they did on via LinkedIn. It was a very small prototype, to demonstrate the ordering mechanism of digital ordering on the vending machine before they built all this technology driven assets that they have today. So it can actually be all those duct tape, but the point I'm trying to make is the intention of the MVP is not that. The intention of the MVP is not you want to build something cheap, something rough, and just put it out there in the market. In fact, if we go back to the original definition of what the MVP means and where it came from, the term was initially coined in 2001 by someone called Frank Robinson, who was the CEO of SyncDev. And in his definition, he says that the MVP is that unique product that maximizes return on risk for both the vendor and the customer. So when you look at the risk return framework, you want what will maximize that risk return curve or whatever it is for both the vendor and the customer. That term, the MVP, was later popularized by Steve Blank through his customer development methodology. And then eventually, what I think most of us will be familiar with is the book written by Eric Rice in 2011, The Lean Startup. And in that book, Eric defines it as the version of a new product that allows a team to collect the maximum amount of validated learning about the customers with the least effort. So it's really about what can I put out there in the market that helps me to collect as much information from the customers to help me then iterate and build a fully featured solution. The reality is that many businesses, when you start, it is never when you come up with the idea and you're doing the research, what really becomes successful at the end of the day is usually very different from what you started with. And you can ask everybody who has built businesses, whether it's Facebook, whether it's Airbnb, most of them built something, Instagram, WhatsApp, they built something hoping to solve a problem. But as they built and they iterated, what they are solving today is completely different from what they set out, the problem they set out to solve in the first place. So what I'm saying is that the MVP is not your worst version. It's not the worst. It's not supposed to be the worst version of your product. It is the most honest version of your product. It strips away everything except the core value. Test the core value. If the core value is there, then you can build and scale on that. So I'll bring it home in the African context. I tell people this a lot, that things can fail. People can iterate, experiment, and fail in many markets. Africa is not as forgiving of such failures. And it doesn't mean that we should not embrace failure in the process of building. I think it's inevitable. The point is, if you can avoid failure on a large scale, then you should. And the first reason is because there's capital constraints in Africa. We don't have as much gunpowder as they do have in other developed markets of the world. So when you're building with limited personal savings, you borrow money from family and friends or from an unforgiving venture capital group, who, when you fail, the likelihood of you being able to raise again becomes difficult. Then you have to be very careful that what you're building, you are giving it the best chance of success. So you're not chasing down a pipe dream that might not be real, but you are putting all efforts into building something that then you can't scale because you've tested and you know this is really the problem you're solving, and this is a solution that people are willing to pay for in response to that problem that you're solving. The second thing is the market unpredictability. The reality, and I've said this many times as well, that is that the African market is not monolithic. So it wears different hats, different shades at different times. Two markets might be close to each other, but they behave completely differently. Cultural context is there. There's barriers in terms of infrastructure limitations. You have challenges around payment behavior. You have issues around, on the language differences. So there are all these constraints that makes the market more complex than it is. So there is definitely benefit in creating something that you can then adjust until you refine enough to be able to get to the right solution for that problem that you're trying to solve. So if we bring this in terms of the practical, how we've seen this play out in the market, a very good example we all know is Space Stack. It was started by Shola and Ezra, and when they started in 2015 in Nigeria, in this instance, during that period, payment integration or integrating online payment was quite, a very it was a very difficult thing to achieve, because time work, the paperwork that needs to be done, the bank liaison, technical setup, all these things take time, take effort, take a lot of money, and becomes impractical for small businesses to be able to access that kind of technology. And what Shola then, who was a software engineer, what he was betting on, he worked in banking, and he felt that he could reduce that timeline from as much long as 3 weeks in integrating your business online to as short as 30 minutes. That is a core assumption that he was trying to test. Now, what did the team do? Did they build out something fancy, putting all the time, effort into building all the technologies to solve that problem? No, rather, What they did was what Shola called an underground walk. They built the core product while they were manually serving a wait list of about 300 merchants. In other words, there was a wait list of 300 merchants. They were solving that, they were manually serving them. In other words, they were probably helping them to do that process of setting their business online while they were then building the core product, which would then make it help them to fulfill their value proposition of reducing it to 30 minutes. So they worked with these 300 businesses directly. They iterated the product based on real feedback they were getting from the customers. They refined, they integrated, and they proved they were able to prove that the claim, the core claim that they had, which is the businesses could go live on payments in 30 minutes. They were able to prove that claim while doing that and solving the problem for those 300 customers. It was only after they had proven that claim and they had validated the iteration that they were then accepted into the Y Combinator. It was then that they were ready to scale that solution, and they were the first ever Nigerian company to be accepted into the Y Combinator, and they received some seed funding as well. Eventually, they officially launched in January 2016, and the market responded very well. By 2020, Paystack was serving over 60,000 businesses across Nigeria. By October that same year, Stripe acquired them for over $200 million, and that became the largest acquisition out of Nigeria. So they did not launch with everything that they had in mind. They tested the core product and they launched with that. A more global story that we also might be familiar with is the story of Airbnb. Airbnb was started in October 2007 by the duo of Brian Chesky and Joe Gebbia. These were two designers who were living in San Francisco apartment. They couldn't make their rents, and there was a major design conference that was coming to the city. Every hotel had been booked, and what they thought then that, look, maybe there might be something here about renting floor space in your house to strangers, allowing strangers to come to your home. There are two parts to it. Would people be willing to accept strangers to sleep in their houses? The other things that would the strangers be willing to sleep in somebody else's house that they don't know, which is not a hotel? They didn't build a product. They didn't build a platform to test that. All they did was they set up a landing page, put out that notice, and then they got 3 air mattresses. They put it on the floor of their living room, and they offered freshly cooked breakfast, all for $80. And guess what? 3 strangers showed up. They paid, and they slept on their floor. They were satisfied, had a good breakfast, and it was that was it. They tested that, and the core assumption of that business model, which is people will pay, strangers will pay to sleep in another person's home, was tested. It was only on the back of that they started building the actual engine that we see today as Airbnb. So if I summarize the lessons from those two stories, what I'm taking out from it is that Paystack's MVP was to manually serve a wait list of 300 merchants, and they iterated over a year before they publicly launched the product. Airbnb's MVP was 3 air mattresses, freshly cooked breakfast for 3 strangers. Neither of those examples was an example of cheap or rough. They were focused on proving the one thing that had to be true before everything else made sense. That is what an MVP is. That is what a minimum viable product, that is what it is. So this is 4 decisions every MVP requires. There are 4 decisions that every MVP requires to hold true. The first decision is the MVP needs is, what is that one assumption your business cannot survive being wrong about? When you set out, there was a problem you're trying to solve, and in solving that problem, you felt like this has to be true. For this solution to really be able to solve this problem is either because this problem is true, and I believe that this solution is the right fit for this problem. There has to be a core assumption that your business believes. For Paystack, that assumption was that the businesses will pay for a faster, simpler payment integration for themselves. If they can be integrated in a shorter time, they will pay for it. For Airbnb, it was the assumptions that strangers would sleep in somebody else's home. Until that was confirmed, no platform, no insurance product, no global expansion, was done, and it didn't make sense to do it at that point until those core assumptions were confirmed. So what I will ask of you is, You need to write down every assumption your business makes. I'm sure there are many of them. Then look for that one that if it turns out to be false, it will make every other thing irrelevant. If there's an assumption that if false, every other thing becomes irrelevant, then that assumption is what your MVP must be set up to test. That's the first decision. The second one is, what is the MVP? What's the minimum you need to build to test that assumption? Remember, we said it is not cheap or rough. It is you testing the core idea. So once you figured out what the core idea is, what is the minimum you need to build to test that assumption with real customers? I'll give you an example. I told you the story of how I introduced the escape room concept into Nigeria. When we started escape room, the excitement, the passion I had for that kind of game, I loved it, and I wanted Nigerians to experience that as well. And I launched in the market. Shortly after I launched, I started spending more time understanding the entertainment industry, and I realized that there were certain core fundamental assumptions that makes those kind of business successful in a market. And out of those three core assumptions, I think about two of them we didn't meet that at that point. Lagos did not meet those requirements, and therefore I overlooked those things. What I could have done differently with the benefit of hindsight is setting up an escape room is capital intensive. You get a room, you build in all these gadgets, all these MI6 type gadgets, automated and all that. It's capital intensive. But there is a cheaper version that actually would have tested and proven if that business concept would be acceptable and if people will pay the right price for it. I could, for example, have gotten a van and set up a mobile escape room at the back of a van, something that is big enough for people to go in, do their thing, solve some problems, a smaller miniature version, which existed in other parts of the market. And the good thing is, because it's mobile, people don't have to come to me. I can take it to them and they pay, and then I can test, will people enjoy this at scale? And then I can then go back to either raise the right investment to be able to put into that kind of establishment. But I didn't do it that way. Rather, the excitement, and I put in the business, and eventually it failed. So what the question is, what is the minimum assumption you're trying to test? For me, at that point, the minimum assumption I should have tested was, would people pay this price to have this kind of fun? There are many types of fun people can have. Nigerians can go sit, in a bar to have drinks, go to a restaurant with friends. There's so many ways people have fun, right? But the question is, I was trying to create a different type of fun, and I had to be sure that people were willing to pay what would be a premium to be able to have this kind of experience. And that is what you want to do by what is the minimum you need to do to, to be able to test that idea. Then the third decision is, what does success look like? You need to be able to say clearly before you start it, because if you do not, everything you do will look like success to you, because it becomes the tail wagging the dog, right? But you want to set, what are the expectations? Okay, these are the number of customers that I will have. This will be the retention rate that will show that this is successful. This is the price point that economically it makes sense for me to sell this product. And when you think about all those different loops, you now begin to zone in on, okay, these are the things I will measure to be able to demonstrate that this thing is a success. The final decision is, what will you do with what you learn? The MVP is a learning loop. Whatever you learn, you double down on it if it's successful. If it's not successful, you pivot, you change, you reimagine your assumptions, and then you do it again, and then you put it in front of customers again. The worst possible outcome of an MVP is launching it and then not paying attention to the customers that are actually using it and what they do with it. The data points, the data itself that you're getting from that process is the whole point of the MVP, because that is what you are rebuilding and you are reiterating into the business itself. So what's the takeaway from this episode on building an MVP? The MVP exists to teach you what your business actually is. That is the sole responsibility and purpose of the MVP. Every major company that you admire, and I've named some of them, every single one of them, they started with a version of themselves that was smaller, that was rougher, that was more focused than what they eventually became today. What you see them as today was not where they started from. And was not because they could not imagine the full version. Sometimes they could not imagine the full version, but other times it's also because They just wanted to be sure that they were solving a real problem. So you do not need to build everything to start. You need to build one thing that proves everything else is worth building. So here's my call to action. One, if you're at an idea stage, write down that one assumption your business cannot survive being wrong about. Then ask yourself, what is the smallest thing that you can build or do this month to test it? The second thing is, if you're looking or if you're already building, I want you to look at your current roadmap. What features or which of the features are proving the core assumptions that you have, and which are comfort features you added because they just felt safe? Cut the comfort features, cut every fluff, and just focus on the core product. The reality is that the core product is solving a core need. The people that have that core problem, they don't, the fanciness around it is not the key thing. As long as you're solving that core problem, they will gravitate towards you. They will use that solution. They will pay for that solution. And the last thing is, share this episode with any founder who is deep, very deep in the build phase, and they've not yet spoken to any customer about what they are building, and or to find out or to figure out if this is the right thing for them to build. Thank you very much for listening. This is the seventh episode in the new series we've been doing on the Diary of an African Entrepreneur. And we're building momentum in phase two. That's the whole idea. We started with the foundation. In phase two, we are building the right momentum. In the next episode, we're going to be showing how to understand your customers' real problems, because even after you validate and you've done your MVP, the single one common reason growth stalls or slows down is that entrepreneurs are solving the problem they assumed the customer has, not the problem the customer actually experiences. They are two different things. In fact, some people, there's a funny thing that you see some people build solution looking for problems. You want to build solutions for problems that exist and that are painful enough for somebody to pay for. Thank you very much again for listening. Please do subscribe to the channel so that we can continue to bring these episodes to your feed. Share with your friends, share with your loved ones, share with entrepreneurs that you know. I'm Deji Adebusoye. I'm the host of Diary of an African Entrepreneur. Until we'll see in the next episode, keep building. Thank you.